Welcome to the Explainer. Go ahead and grab a seat at the investment committee table because today I'm going to be playing the role of your senior value analyst. We are putting two fast casual titans head to head, SHAK versus Chipotle.
We are starting right at the scene of the crash. Following their Q1 2026 earnings report, Shake Shack stock took a massive 30% plunge. And, they aren't suffering alone out there. Chipotle stock is also down more than 30% this year.
So, all this extreme volatility really begs the ultimate Warren Buffett question, doesn't it? Are we looking at a nasty value trap, or is this a wonderful business just sitting there on sale? We're going to tear into the SEC filings, earnings data, and sector reports to see if the underlying fundamentals actually justify this sell-off, or if the market just handed us a mispriced gem. Here's our 5-step, Buffett-style game plan. We'll outline the companies analyzed, compare their businesses and moats, dive into the deep financials, run some quantitative valuation models, and finally, deliver a margin of safety verdict.
All right, step 1. The companies analyzed. Just to set the ground rules here, we are strictly bound by the provided documents for this brief. For Shake Shack, we're relying entirely on their Q1 2026 8K, their earnings release, and analyst forecasts from Stifel and Wall Street Zen. And for Chipotle, our insights are drawn directly from a Q1 2026 sector analysis by The Motley Fool.
Moving right along to step 2, assessing the business and moat.
Right out of the gate, the momentum difference between these two is pretty wild. Shake Shack is demonstrating immense pricing power. I mean, they've posted 19 consecutive quarters of same-store sales growth, and that's even while raising prices. Conversely, Chipotle kind of seems to have lost its footing lately. They just reported a meager 0.3% same-store sales growth and are reportedly bleeding low to mid-income diners.
You see, Shake Shack's continued culinary innovation really acts as a narrow economic moat. Just take a look at what CEO Rob Lynch noted. Their new smoky barbecue menu platform, especially that new boneless baby back rib sandwich, drove 8% comps and 5% traffic growth in just its first week. That translates directly to brand loyalty and, crucially, pricing power. When we run both of these through the classic Buffett checklist side by side, Shake Shack presents an expanding runway with aggressive plans to literally triple their store count. But let's look closely at Chipotle's management column for a second. Executing a $687 million stock buyback at an average price of $42.39, right before the stock cratered 30%, raises some severe red flags regarding their capital allocation strategy.
Okay, let's get into the weeds. Step 3, deep financial comparison.
Looking at the hard numbers, Shake Shack's top line is absolutely humming. Revenue grew 14.3% to $366.7 million, with restaurant-level margins expanding to a very healthy 21.2%. Now, while our provided data on Chipotle is a bit limited here, we do know their margins are compressing alongside those slowing sales. But hey, the critical line item for Shake Shack is operating margin, because despite record revenues, they actually posted a $2.6 million operating loss.
Now, of course, management is super eager to point to their adjusted EBITDA of $37 million. But come on, as value investors, we know adjusted EBITDA is usually just corporate speak for earnings before all the bad stuff. We really have to view this with extreme skepticism because it completely strips out very real recurring cash expenses.
In fact, if you dig into the 8K, you'll see exactly what vaporized that operating profit. General and administrative spending absolutely ballooned to $53.6 million. And pre-opening costs surged to $6.8 million as they rapidly expanded with 17 new locations. The takeaway? Growth is incredibly expensive right now, and it is eating directly into owner earnings.
All right, that brings us to step 4, our quantitative valuation models.
Wall Street Zen analysts are pricing in a massive growth runway for Shake Shack. I mean, they project earnings per share climbing from $1.41 in 2026 all the way up to $2.38 by 2028. That is an aggressive 31% forecasted annual growth rate.
To figure out a fair price, we're dusting off the classic Graham intrinsic value formula. Basically, this model attempts to find fair value by balancing forecasted EPS, the expected long-term growth rate, and the current yield on AAA corporate bonds.
Now, full disclosure time. Based purely on the dockets provided for this briefing, we're actually missing a few critical inputs to run a totally rigorous discounted cash flow model.
To finalize the exact DCF intrinsic value, I am going to need you to provide the current AAA bond yield, the exact maintenance capex, and the cost of equity so we can calculate our weighted average cost of capital.
But honestly, we don't always need a flawlessly precise DCF to spot an overpriced asset. We do know Shake Shack's current price-to-earnings multiple is sitting at a lofty 84, when the S&P 500 average is hovering somewhere near 30. You are paying a massive speculative premium, no way around it.
Which leads us to our final stop. Step 5, the margin of safety verdict. All right, here's the bottom line for the committee. Even with that 30% haircut, Shake Shack trading at $64.50 or 84 times earnings offers absolutely zero margin of safety for a disciplined value investor. For us, it is a hold or a pass. And as for Chipotle, at $31.92, with fading same-store sales momentum, the future cash flows are just too uncertain. It's a firm pass.
So, what does this all mean? Look, Shake Shack might genuinely be a wonderful business with a huge runway for expansion ahead of it. But at 84 times earnings, it's just not sitting at a sensible price. It leaves us with this classic dilemma. Will this company eventually grow into its sky-high valuation, or are investors just paying for the sizzle instead of the steak? Definitely keep that in mind as you review your portfolios. Thanks for joining the committee today, and we'll catch you in the next explainer.